Here is the uncomfortable truth about investing. One individual stock can change your life, but one individual stock can also destroy years of progress. If you bought the right business early, held it through volatility, ignored panic, understood the financials, and let it compound for decades, individual stocks could outperform almost any ETF. That is the dream. One Amazon, one Apple, one Nvidia, one great Canadian bank bought decades ago. One incredible company held long enough to become life-changing. But here is the other side. Most people do not only buy the winners. They buy hype. They buy stories. They buy stocks after the move already happened. They panic when the stock drops. They average down into broken businesses. And sometimes they spend years holding a stock that never recovers. That is why the individual stocks versus ETFs debate is not really about which investment has more upside. Individual stocks clearly have more upside. The real question is, can you actually identify the winners, hold them long enough, and avoid the losers? Because an ETF does something individual stocks cannot do. It removes the need to be right about one company. Instead of betting on one business, you own hundreds or thousands of businesses at once. Less upside from a single winner, but much lower risk of one mistake destroying your portfolio. So which one actually builds more wealth? The honest answer depends on 5 variables: skill, time, temperament, diversification, and whether you are building your core portfolio or taking satellite bets. This video breaks down the real difference between individual stocks and ETFs, and by the end, you will know which one actually makes sense for your situation. Let's start with individual stocks. When you buy an individual stock, you are buying ownership in one specific company, not the whole market, not a basket, not an index. One company. If that company performs extremely well, your return can be extraordinary. This is why stock picking is so attractive. An ETF might own hundreds of companies, but an individual stock lets you concentrate your money into your best idea. If you are right, concentration can build wealth faster than diversification. That is the upside. But the downside is just as important. When you buy one stock, you take on company-specific risk. Bad management, too much debt, declining revenue, disruption from competitors, a failed product, a lawsuit, a recession that hurts that company more than the market. A stock can fall 50%, 70%, 90%, or even go to zero. And unlike an ETF, there may be no automatic recovery. The market can recover while your individual stock never does. That is the part beginners underestimate. A stock is not cheap just because it has fallen. Sometimes it is cheaper because the business is weaker. And if you are buying individual stocks, you have to understand what you own. You need to know how the company makes money. You need to understand its balance sheet. You need to know whether earnings are growing or shrinking. You need to know whether the valuation makes sense. And you need to know what would prove your thesis wrong. That is why individual stocks can be powerful. But they are not passive. They require judgment. They require research. And most importantly, they require emotional control. Your action step: pick one individual stock you own or are considering. Write down in one sentence why the business should be worth more in 5 years. If you cannot explain it simply, you may not understand it well enough yet. Now let's look at ETFs. An ETF is an exchange-traded fund. That means it trades on the stock market like a stock. But instead of owning one company, you usually own a basket of companies. For example, a broad market ETF might hold hundreds or even thousands of stocks. Canadian companies, US companies, international companies, banks, technology, healthcare, energy, industrials, consumer goods. Instead of trying to pick the one perfect company, an ETF gives you exposure to the whole group. That is the power. If one company fails, the ETF does not go to zero. If one sector struggles, other sectors can help offset the damage. If one country underperforms, global diversification can reduce the impact. An ETF is not designed to make you feel like a genius. It is designed to keep you in the game. That matters more than people think. Because most investors do not fail because they earn slightly lower returns. They fail because they make one or two large mistakes. They overconcentrate. They panic sell. They chase hype. They buy businesses they do not understand. A broad ETF helps protect investors from their own worst behavior. The trade-off is clear. You will not get the full upside of one incredible stock. If one company inside the ETF goes up 1,000%, that winner is only one part of the basket. But that is also the protection. If one company collapses, it is also only one part of the basket. ETFs reduce the importance of being exactly right. And for most people, that is a major advantage. Here is where the individual stock debate gets serious. It is not impossible to beat the market. Some investors do. Some individual stocks destroy the index. Some concentrated portfolios create enormous wealth. But the question is not whether it is possible. The question is whether it is probable. S&P Dow Jones Indices publishes something called the SPIVA Scorecard. It compares actively managed funds against their benchmarks, and the results are uncomfortable. In the 2024 SPIVA Canada Year-End Scorecard, over 80% of active Canadian funds underperformed their benchmarks across categories. In Canadian equities specifically, 88.7% of active funds underperformed. Dividend and income equity funds were even worse that year, with 95.8% underperforming. Think about what that means. These are professionals. They have research teams. They have analysts. They have models. They have access to management calls. They have more information than the average retail investor. And most still failed to beat the benchmark. That does not mean you cannot pick stocks, but it means you need humility. Because every time you buy an individual stock instead of the index, you are making a statement. You are saying, I believe this company will outperform the basket. That might be true, but it needs to be based on analysis, not vibes. The index does not need to find the winner ahead of time. It owns the winners as they become winners. That is the hidden advantage of ETFs. You do not need to predict which companies will dominate the next decade. You just need to own the market that includes them. Your action step. Before buying an individual stock, compare it to the ETF you could have bought instead. Ask, what specific edge do I have that makes this stock worth the extra concentration risk? Now let's talk about the part nobody wants to admit. Investing is not only about returns, it is also about maintenance. Individual stocks require ongoing attention. You need to read earnings reports, track revenue, watch margins, follow debt levels, understand management decisions, monitor competition, and update your thesis when the facts change. That takes time. For some investors, that is enjoyable. For others, it becomes stressful. ETFs are different. A broad ETF can give you diversified exposure with very little maintenance. You still need to choose the right asset allocation. You still need to understand risk. You still need to stay invested. But you do not need to analyze every company inside the fund. That is why ETFs are powerful for busy people. If you work full-time, run a business, train, study, or simply do not want investing to become a second job, ETFs can create a simple system. Fees matter too. Many Canadian broad market ETFs charge low management expense ratios. Some all-in-one asset allocation ETFs have fees around a fraction of 1% per year. That does not mean fees are the only factor, but lower fees leave more of the return inside your portfolio. The real advantage is not just cost, it is behavior. A simple ETF portfolio is easier to stick with, and a strategy you can actually stick with for 30 years is usually better than a complicated strategy you abandon in 3. Your action step. Calculate how many hours per month you realistically want to spend managing investments. If the answer is close to 0, your portfolio should probably be ETF heavy. Here is the real reason ETFs make sense for most investors. Not because individual stocks are bad, but because human behavior is unreliable. When you own one individual stock, every price movement feels personal. If it drops 20%, you question yourself. If it drops 40%, you panic. If it doubles, you think you are a genius. If someone online says the stock is dead, you doubt your thesis. If someone says it is going to the moon, you get greedy. That emotional pressure is real. And the more concentrated your portfolio is, the louder that pressure becomes. ETFs reduce that pressure. If one company inside the ETF falls, it is not your entire future. If one sector underperforms, the whole portfolio does not depend on it. If one CEO makes a mistake, your financial plan does not collapse. That makes it easier to stay invested. And staying invested is one of the biggest advantages an ordinary investor can have. The average person does not need to beat the market to build wealth. They need to avoid destroying their own plan. This is why a core and satellite strategy makes sense. Your core portfolio is built with ETFs. That is the stable foundation. Then, if you truly enjoy stock picking, you use a smaller satellite portion for individual stocks. Maybe 80% ETFs and 20% individual stocks. Maybe 90% ETFs and 10% individual stocks. The exact number depends on your risk tolerance and skill, but the principle is simple. Let ETFs protect the foundation. Let individual stocks express your best ideas. That way, one bad stock does not ruin the whole plan. Your action step: look at your portfolio and calculate your largest individual stock as a percentage of your total investments. If one company makes up more than you can emotionally handle losing half of, you may be too concentrated. Now let's make this Canadian. Whether you buy individual stocks or ETFs, the account you use matters. Inside a TFSA, capital gains and investment income can grow tax-free. That makes the TFSA powerful for both ETFs and individual stocks. If your ETF grows for 30 years inside a TFSA, the gain is tax-free. If your individual stock becomes a huge winner inside a TFSA, that gain is also tax-free. That is why the TFSA can be incredible for long-term investing. The RRSP is different. RRSP contributions can reduce taxable income today. Investments grow tax-deferred, but withdrawals are taxable later. For many Canadians, RRSPs make sense when they are in a higher tax bracket today and expect a lower tax bracket in retirement. Then there is the non-registered account. This is where taxes matter more. Canadian dividends may receive the dividend tax credit. Capital gains are generally taxed more favorably than interest income. But you still have tax reporting. You still have realized gains. You still have taxable distributions. And with ETFs, you need to understand that distributions can include dividends, foreign income, capital gains, and return of capital depending on the fund. The point is simple. Individual stock versus ETF is one decision. TFSA versus RRSP versus non-registered is another. A great investment in the wrong account can still be less efficient than it could have been. For most Canadians, a simple order often makes sense. Build the TFSA. Use broad ETFs as the core. Add individual stocks only if you understand the businesses and can handle the risk. Then use RRSP and taxable accounts based on income, tax bracket, and long-term plan. Conclusion. The honest answer: ETFs for the core, stocks for your best ideas. So, which one actually builds more wealth? Individual stocks or ETFs? The honest answer is this: individual stocks have higher upside. ETFs have higher reliability. Individual stocks can make you rich faster if you are right. ETFs can keep you from ruining the plan if you are wrong. And for most Canadians, that means the best answer is not one or the other. It is both, but with different jobs. ETFs should usually be the core. They give you diversification, low cost, simplicity, global exposure, and a strategy you can actually stick with for decades. Individual stocks should be the satellite. They are where you express your strongest ideas, but only with money you can emotionally handle being wrong with. Because the goal is not to look smart. The goal is to build wealth. And wealth usually comes from staying invested, avoiding catastrophic mistakes, and letting time do the heavy lifting. So if you are a beginner, start with ETFs. Build the foundation. Learn how markets work. Learn how businesses work. Learn how you behave during volatility. Then, if you still want to pick individual stocks, do it intentionally. Not because of hype, not because of social media, not because you want fast money, but because you understand the business and accept the risk. That is the real answer. ETFs protect your future. Individual stocks can accelerate it, but only if you know what you are doing.